Well, I was sitting in my office today, looking out of the same window I've stared through for decades. Same desk, same chair, same faint smell of old paper and wooden drawers that don't quite close the way they used to. And as I sat there, it occurred to me that in this world of constant noise and constant movement, there is incredible power in knowing what doesn't change. The things that remain steady while everything else is spinning, those are the things worth paying attention to. There's a storm coming in the financial markets. Not the sort of storm people panic about. No, this one is different. It's what I've come to call the Great Transfer. And I don't use that phrase lightly. In my 90 plus years on this earth, I've never seen anything quite like what's taking shape. Most people won't notice it, of course. They'll be scrolling, reacting, chasing, and by the time they look up, the moment will have already passed them by. You see, I've lived through more market cycles than I can comfortably count. I remember the fear in the air during the crash of '87. I remember the dot-com bubble, the optimism that turned into chaos. I remember 2008, when the world seemed to be unraveling thread by thread. Through every decade, every cycle, the same ancient pattern shows its face again. Fear and greed, rising and falling like the tide. And every time the tide shifts, it reveals who has been steady and who has been swept away. But what's coming now is different. Not in nature, but in scale. It's generational. It's a seismic shift of wealth from one group of people to another. And the dividing line between those groups isn't income or status or credentials. It's something much simpler, something most people overlook. People ask me all the time, Warren, what's the secret? They lean in, expecting some complex formula, some secret equation I've hidden in a vault somewhere in Omaha. And I always tell them the truth. The secret is that there is no secret. The answers are in plain sight, available to anyone patient enough, disciplined enough, humble enough to see them. Let me tell you about my first investment. I was 11 years old and I bought 3 shares of City Service Preferred at 30 LA each. The stock fell almost immediately to 27. Now imagine being 11 years old, watching nearly a third of your money evaporate. I was terrified. I waited until it crawled back to $40 and I sold. And wouldn't you know it, not long after, it ran to $200. That was my earliest lesson in patience, in resisting the urge to act out of fear. And I've been learning that same lesson again and again ever since. Most investors today behave like that 11-year-old version of me. They can't stand discomfort. They can't stand watching numbers go down. They believe investing is about constant activity. Buying, selling, trading, adjusting. They think the key is motion. But real investing is mostly the absence of motion. It's the willingness to sit still, to tolerate boredom, volatility, uncertainty, to do nothing when doing nothing is the hardest thing in the world. Charlie Munger, my partner for nearly 60 years, said something that belongs carved in stone. The big money isn't in the buying and the selling, but in the waiting. The waiting is everything. The waiting is where the real compounding happens. Not just financial compounding, but emotional compounding. The strengthening of patience, discipline, and clarity. Now let's talk about this transfer. What is it really? It's not a law. It's not a policy. It's not a program. It's something much older than any government and far more predictable. It is the natural consequence of human psychology colliding with market cycles. It is the movement of wealth from the impatient to the patient, from the reactive to the rational, from the person who needs excitement to the person who can tolerate stillness. Wealth moves from those who chase noise to those who understand signal. Picture 2 farmers, Farmer Jones and Farmer Smith. Jones plants his seeds but can't leave them alone. Every few days he's digging them up to check if they're growing. He rearranges them, waters them too much, then too little, tries a dozen different methods he found online. Smith plants his seeds too, but once they're in the ground, he lets nature do the work nature has always done. He checks his fields, tends them, but he never interrupts the process. He respects the timeline of growth. You already know which farmer gets the better harvest, and yet when it comes to investing, most people behave like Farmer Jones. They check prices all day long. They obsess over the headlines. They panic when things fall and grow euphoric when things rise. They interrupt compounding again and again, and then wonder why they aren't getting results. This great transfer will be from the Farmer Joneses to the Farmer Smiths. And let me tell you, there are far more Joneses out there. If you want to become a Smith, start with this. Know what you own and know why you own it. If you can't explain the business to a 10-year-old, you probably have no business investing in it. Complexity doesn't make something smarter. Complexity makes it fragile. Simplicity is strength. I'm reminded of one of the best deals Berkshire ever made, See's Candies. We bought it in 1972 for $25 million. People buy candy for holidays, birthdays, special moments. They're not comparing prices when they're buying something sentimental. The business had pricing power. Since our purchase, See's has generated more than $2 billion in earnings, all by doing what it always did, delivering something people love. No technological breakthrough, no reinvention, just consistency and quality. That's the model. Find wonderful businesses at fair prices and let them compound quietly in the background, while the rest of the world panics over the next headline. And here's a test I use, one that has guided countless decisions. If the stock market shut down for 5 years, would I still be happy owning this business? If the answer is no, I shouldn't even own it for 5 minutes. Most people can't pass that test because they're not thinking like business owners. They're thinking like speculators. They're focused on price, not value. And that brings me to an old friend of mine, Mr. Market, a fictional character Ben Graham created to represent the emotional swings of the market. Some days he's euphoric, willing to buy anything at ridiculous prices. Some days he's depressed, selling wonderful businesses for scraps. Your job is not to mirror his mood. Your job is to take advantage of it. And this transfer that's coming, well, it will happen during one of Mr. Market's mood swings. It always does. Now, if we're going to talk about Mr. Market, we need to talk about something else just as important. The margin of safety. This idea, taught to me by Ben Graham, has protected me more times than I can count. It's simple in theory, but remarkably rare in practice. The margin of safety means you never buy something right at the edge of its value. You buy it well below what you think it's worth. That way, even if your judgment is slightly off, even if conditions change, even if the unexpected shows up, your investment still stands on solid ground. Think of it like building a bridge. If you need it to hold 10,000 pounds, you don't construct it to hold exactly 10,000 pounds. But in today's world, the margin of safety has become unfashionable. People buy things at absurd prices because they're afraid of missing out. They're speculating, hoping someone else will take it off their hands at a higher price. That's not investing. That's gambling dressed up in financial language. And whether people admit it or not, the outcomes are always the same. The great transfer of wealth will heavily favor those who insist on a margin of safety, those who refuse to chase, those who are willing to wait, the ones who treat investing not as a sprint, but as the long walk it truly is. Let me give you an example that shaped this belief deeply. During the financial crisis of 2008-2009, fear was everywhere. Turn on the television and you'd see experts predicting the end of capitalism. Open a newspaper and you'd see panic in every headline. It felt as if the entire world was coming apart at the seams. And what were we doing at Berkshire? We were buying. We invested billions into companies that had been household names for generations. People thought I'd lost my mind. They said I was too old, too out of touch, too optimistic. What they didn't understand was the principle of the margin of safety. We weren't betting the world wouldn't end. We were betting that if it didn't end, and historically the world has a pretty strong track record of not ending, then those companies were being sold at once-in-a-lifetime prices. The cushion was enormous. The risk, despite how it felt emotionally, was small. And with time, that decision paid off handsomely. This is the heart of the transfer. When fear grips the world, most people run. A small handful walk forward. Fear clouds judgment. Fear pushes people into bad decisions. Fear convinces them to sell what they should be holding and hold what they should be selling. Fear turns temporary declines into permanent losses. Temperament, more than intelligence, is what determines who ends up on the right side of this transfer. To succeed in investing, you don't need the highest IQ. You don't need to know calculus. You don't need to understand option pricing models. or memorize economic theories. You need something much rarer. You need emotional stability, the ability to stay level-headed when everyone else is losing their balance, the willingness to stay calm in storms and humble in sunshine. I often compare temperament to weather in Nebraska. We experience everything here: heat, cold, storms, calm days, tornadoes. If you made long-term decisions based on daily weather, you'd be in constant chaos. Investing is no different. You cannot determine your strategy based on day-to-day market movements. You need to understand the seasons. You need to expect storms. And you need to know they always pass. This great transfer of wealth will test people's temperaments like never before. We live in a time when information moves at the speed of light, when opinions are broadcast instantly, when fear can spread through millions of people within minutes. That speed amplifies emotions, it accelerates overreactions, and it increases the likelihood of people making decisions they later regret. But here's the beautiful part. The faster the world reacts, the more valuable patience becomes. Now let us talk about the single best investment you'll ever make. And it has nothing to do with the stock market. The greatest investment you can ever make is in yourself. Your knowledge, your skills, your ability to think clearly, those are assets no one can take away. They don't crash. They don't get marked down in recessions. They don't vanish when the economy wobbles. They compound quietly, steadily, unfailingly. People sometimes think that at my age I'd slow down on learning, but I've never read more in my life. 5 to 6 hours of reading every day, annual reports, books, newspapers still excite me. Why? Because every new piece of information expands the mind's toolkit. Charlie Munger calls them mental models, the frameworks that help you understand how the world works. The more of these models you have, the more clearly you can see opportunities others miss. If you want to place yourself on the winning side of this great transfer, become a learning machine. Read broadly. Study businesses, learn about human behavior, understand history. The more you know, the more you'll recognize patterns that repeat through time. And once you see those patterns, you'll realize the world is far more predictable than it appears. Now let's talk about something magical, something that works quietly, invisibly, relentlessly on your behalf. Compounding. Compounding is what happens when your returns begin generating their own returns. At first, the effect is small, so small that many people barely notice it. But over decades, compounding becomes a force so powerful it feels like a miracle. There's an old story about the inventor of chess asking the emperor of China for 1 grain of rice on the first square of the chessboard, 2 on the second, 4 on the third, doubling each time. By the 64th square, the amount of rice needed exceeded all the rice on earth. That's exponential growth. That's compounding. Most people underestimate it because they think linearly. They expect progress to look like 1, 2, 3, 4. But compounding looks like 1, 2, 4, 8, 16, 32. It grows small, but then surges almost violently in later years. The great transfer will overwhelmingly favor those who understand compounding, who start early, who stay committed, and who don't interrupt the process. Every time you sell, every time you jump in and out based on emotion, you're cutting your snowball in half just as it starts to grow. At Berkshire, we think of ourselves as caretakers of compounding. We don't chase fast money. We don't look for flashy gains. We look for long hills and wet snow, businesses that can compound for decades. Mistakes, of course, are inevitable on this journey. I've made plenty. Dexter Shoe Company cost us billions. Countless other mistakes followed. But here's what matters. Your mistakes must be small, and your winners must be allowed to become enormous. Most investors reverse this. They take quick profits because feeling right feels good. Then they let losers run because admitting a mistake feels painful. That's backward thinking. To avoid the wrong side of this transfer, keep your losses small, let your strengths grow, and never interrupt a compounding machine. Now let us continue by looking at what preparing yourself for this great transfer actually means in practical terms. Because principles are essential, but without application they remain just ideas floating in the air. Preparation begins with adopting an investor's mindset. Not a trader's mindset, not a gambler's mindset, not a speculator's mindset, an investor's mindset. When you buy a stock, you're buying a piece of a real business. You're not buying a flickering number on a screen. You're not buying a ticker symbol. You're buying ownership in an enterprise run by real people, serving real customers, generating real profits, facing real challenges, and competing in the real world. Too many people forget this. They look at the stock market as if it does a casino where numbers toggle up and down at random. But investing isn't about guessing price movements. It's about evaluating businesses and deciding which ones you want to own. Once you start thinking like a business owner instead of a trader, everything changes. You stop caring about temporary price swings. You stop reacting to headlines. You stop worrying about what the crowd is doing. You focus on the fundamentals: earnings, management quality, competitive advantages, customer loyalty, durability. These are the pillars that matter. To prepare properly, you need a watch list, a collection of wonderful businesses you've studied deeply, businesses you would love to own at the right price. You should know these companies as if you worked there. You should understand their strengths, their weak spots, their long-term prospects. When an opportunity finally arrives, when fear grips the market and prices fall, you won't hesitate. You won't need to check what the crowd is doing. You'll already know the value because you've done the work in advance. And that brings you to your greatest ally in investing: patience, the willingness to wait for the right pitch, the discipline to sit through long periods of inactivity without feeling the urge to do something just because. And the truth is, investing is a waiting game. Not waiting passively, but waiting intelligently. I think of it this way. Imagine you're a hunter in a forest. If you shoot at every rustling leaf, you'll never hit anything. You'll exhaust yourself. But if you sit quietly and wait for the right moment, the opportunity will eventually present itself. The stock market works the same way. You don't need dozens of opportunities. You only need a handful over a lifetime. A few extraordinary decisions can change everything. But to capitalize on them, you must manage your emotions. This might be the hardest of all disciplines. When markets are crashing, fear spreads like wildfire. It convinces people that this time is different, that the decline won't end, that everything they own is in danger. And when markets are soaring, greed takes over, whispering that the climb will continue forever, that risk has disappeared, that prices will rise simply because they've been rising. Both emotions will lead you astray. Fear will make you sell when you should be holding, or worse, buying. Greed will make you buy when you should be holding, or worse, staying away entirely. Emotional management is the difference between surviving and thriving. You must learn to detach your decisions from the mood of the crowd. Markets magnify human emotion. Your job is to avoid absorbing that emotion. If you can keep your head while others are losing theirs, opportunities open up that most people never see. Thinking long-term is another cornerstone of preparation. And when I say long-term, I don't mean 3 months or even 3 years. I mean decades. If you choose a wonderful business, time becomes your greatest ally. It works silently, invisibly, but with extraordinary power. But you have to give it room. You have to allow compounding to weave its quiet magic. Many people doubt long-term thinking because they believe the world is changing too fast. Technology evolves. Industries rise and fall. Trends shift overnight. But the core principles of evaluating businesses remain the same. You look for durable competitive advantages. You look for honest and capable managers. You look for consistent returns on capital. These principles haven't changed in 100 years, and they won't change in the next 100. Even in periods of rapid innovation, certain characteristics stand the test of time. Companies that delight customers, operate efficiently, grow intelligently, and maintain disciplined leadership. These survive. These thrive. The surface of the market changes, but the foundation remains steady. Another overlooked ingredient for preparing yourself is the simple, powerful ability to say no. Saying no is one of the most valuable skills an investor can develop. There are thousands of investment opportunities at any given time. You're not supposed to chase them all. You're not supposed to dabble in everything. You only need a few great ideas in your lifetime. But to get to those few, you have to say no far more often than you say yes. Saying no protects you. It keeps you from straying outside your circle of competence. It shields you from temptations that appear attractive but lack the qualities of true long-term investments. Most people fail not because they pick the wrong stocks, but because they pick too many. They spread themselves thin. They confuse activity with intelligence. They mistake participation for progress. To succeed, you must be willing to let countless opportunities pass by untouched. You don't swing at every pitch. You wait for the pitch that falls squarely in your sweet spot. For younger people especially, this approach is transformational. If you're young, you possess the most powerful asset in all of investing. Time. Time multiplies money. Time multiplies learning. Time multiplies skill. A young investor who saves a modest amount consistently, invested wisely, and avoids destructive behaviors can build extraordinary wealth. Not because of luck, not because of genius, but because compounding favors time. But youth also brings a temptation to chase quick profits, to try shortcuts, to believe speed equals success. The truth is, slow and steady wins the race, not because it's slow, but because it's steady. A consistent, disciplined approach beats frantic activity every time. For people who are older, it's important to remember, it's not too late. Discipline works at any age. Good decisions compound at any age. Reducing mistakes is valuable at any age. The great transfer of wealth doesn't care about your birth year. It cares about your habits, your mindset, your willingness to adopt principles that endure. And that brings me to a point many people are surprised to hear me say, most people shouldn't pick individual stocks at all. The reason is simple. Most people don't have the time or interest to study businesses deeply. They don't want to read annual reports, evaluate balance sheets, or analyze competitive positions. And there's nothing wrong with that. For those people, low-cost index funds are the best option. You get broad exposure to American business. You participate in long-term economic growth. You avoid the big mistakes that come from chasing fads or reacting emotionally. Even in my will, I recommended that 90% of the money left to my wife go into an S&P 500 index fund. That's how confident I am in this approach. Index fund investors will also benefit from the great transfer because they avoid the catastrophic errors others make. They stay invested. They stay consistent. They let compounding work without interruption. Risk is another concept people often misunderstand. They think volatility, the movement of prices up and down, is risk. But volatility is noise. Real risk is the possibility of permanent loss. And the best way to reduce that risk is by demanding a margin of safety, understanding what you own, and paying sensible prices. The biggest danger in investing is overpaying. A great company bought at a reckless price can become a bad investment. A simple company bought at an attractive price can become a great investment. Price isn't everything, but it is the foundation of everything. The transfer of wealth will happen largely because people misjudge risk. They think something is safe because everyone else is buying it. They think something is dangerous because everyone else is selling it. But crowds are not reliable guides. Markets can be wildly wrong. Prices can detach from reality in both directions. To prepare properly, you must separate your understanding of risk from the emotions of the crowd. The great transfer won't occur in a single moment. It will unfold over years as markets rise and fall, as fear turns into greed and greed into fear. Those who prepare, those who study, think, wait, and act rationally will come out ahead. Those who chase, react, and speculate will find themselves falling behind. Let us continue by looking at what the world tends to forget during periods of calm and what it rediscovers, often painfully, when volatility returns. Market cycles are as old as commerce itself. They rise, they fall, and in each cycle, the same drama plays out. People convince themselves that the present trend will last forever. When times are good, they believe nothing can go wrong. When times are bad, they believe nothing will ever recover. But the truth has always been somewhere in the middle, moving steadily forward while emotions swing wildly around it. This is why preparation matters so much. You can't predict the exact timing of the next decline or the next boom. You can't know which headline will trigger fear or which event will ignite optimism. but you can prepare yourself so that no matter what comes, your decisions remain steady. If you wait until a moment of panic to form your plan, you'll be planning with a trembling hand, and trembling hands make poor decisions. You prepare before the storm, not during it. And the storm that's forming now, the one I've called the Great Transfer, will be a test of preparation more than prediction. It will reveal who invested with intention and who invested with impulse. It will separate the people who understand businesses from those who only chase price movements. It will reward discipline and punish haste. To navigate this coming shift, you need to anchor yourself in principles that have survived every major event of the last century. Principles that outlast recessions, wars, inflation, deflation, bubbles, and crashes. These principles are simple, but they require strength to follow. They require independence of thought. They require the willingness to look foolish in the short term to be proven wise in the long term. Consider this. Nearly every major opportunity I've ever had appeared at a time when others were pessimistic. When fear is in the air, prices disconnect from value. Businesses become misunderstood, overlooked, or abandoned. That's when extraordinary investments emerge. But you won't see them if you're focused on the panic itself. You see them only if your eyes are on the underlying business, not on the noise around it. The great transfer happens when people act on emotion instead of logic. When they sell not because a business has deteriorated, but because the market has frightened them. Or when they buy, not because a business is thriving, but because the crowd is cheering for it. In those moments, wealth shifts quietly from those who move with the crowd to those who move with patience and clarity. Now let us turn to something that matters just as much as patience. Understanding your circle of competence. This idea has guided me for decades. Your circle of competence is simply the set of things you truly understand, not things you think you understand, not things that sound promising, things you genuinely know. The biggest mistakes in investing come from stepping outside that circle and convincing yourself you will figure it out later. You don't need to know everything. You only need to know the boundaries of what you know. And you need the humility to stay within those boundaries. Most people get into trouble not because they lack intelligence, but because they lack self-awareness. They take risks disguised as opportunities. They assume knowledge they haven't earned. And markets have a way of exposing those assumptions. If you stay within your circle of competence and focus on businesses you truly understand, you'll avoid most of the dangers that trap others. You'll recognize value where others see chaos. You'll spot strength where others only see falling prices. And you'll avoid putting capital into ventures that promise excitement but lack durability. Durability is the real treasure in investing. The world is full of businesses that look impressive for a year or two. They grow quickly, attract attention, and then fade. But truly extraordinary businesses endure. They adapt. They expand intelligently. They generate returns without needing constant reinvention. They earn customer loyalty. They build reputations that cannot be bought. These are the businesses that create wealth through compounding. And these are the businesses you want to own during the Great Transfer. But let me tell you something else that matters enormously. The value of simplicity. People often assume that the more complicated something is, the smarter it must be. But complexity often hides fragility. It hides risks. It hides assumptions that collapse under pressure. The best investments are almost always the simple ones. The ones where you can explain the business model in a few sentences. The ones where the drivers of success are obvious, durable, and difficult for competitors to replicate. Complexity appeals to the ego. Simplicity appeals to the rational mind. Choose simplicity. Now we should talk about an uncomfortable but necessary topic, mistakes, because no matter how disciplined, informed, or experienced you are, you will make mistakes. I've made enormous ones. I've invested in businesses that turned out to have no lasting advantages. I've trusted managers I shouldn't have trusted. I've overestimated potential and underestimated challenges. But here's the key. Mistakes are part of the process, not a sign you should quit. The goal is not to avoid mistakes entirely, The goal is to avoid big mistakes that cost you your capital, your discipline, or your confidence. If you can keep your mistakes small and your winners large, you'll come out ahead. Successful investing is less about being right all the time and more about being right when it matters. And that brings us to positioning. What does it look like to position yourself for what's coming? It looks like holding cash, not because you're afraid, but because you're patient. It looks like studying businesses, even when you're not buying anything. It looks like strengthening your understanding when others are chasing headlines. It looks like preparing your watch list so thoroughly that when an opportunity appears, you recognize it instantly. Positioning means building the mindset, the habits, and the discipline that allow you to act when others freeze. It means setting yourself up so that your future decisions don't depend on how you feel in the moment. Emotion is the enemy of intelligent action. The more of your process you build in advance, the less emotion can interfere. When the transfer begins, whether tomorrow or years from now, it will be marked by volatility. Prices will fall faster than people expect. Commentators will predict the end of prosperity. Pessimism will dominate conversations. And that is precisely when the patient, the prepared, and the rational will step forward. They will buy when the crowd is selling. They will hold when the crowd is fleeing. They will build when the crowd is breaking. And years later, when the dust settles, they will look back and realize that the moment everyone feared was the moment everything changed for them. Now, as we draw this long conversation to its close, I want to leave you with a final thought, one that has guided me throughout my life. The most important investment you will ever make isn't in a stock or a company or a piece of real estate. It is in yourself, your habits, your knowledge, your discipline, your ability to think independently. These are the foundations of all future success. Markets rise and fall. Fortunes come and go, but who you become, what you learn, and how you think, those are permanent. The great transfer of wealth is coming. It will reward patience. It will reward clarity. It will reward anyone willing to do the quiet work while the world chases noise. Your future position depends on the decisions you make today, on what you choose to study, what you choose to avoid, what you choose to believe, and what you choose to wait for. You get to decide which side of the transfer you'll be on. You choose it with your temperament, your discipline, your preparation. And if you choose wisely, decades from now you will look back and realize that this was the moment when your snowball began rolling down the hill. Now, if you'll excuse me, there's a cherry coke waiting for me and a stack of reading I've been looking forward to. Remember, start early, stay patient, and let compounding work its quiet magic.